And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we're busting another big myth out there, one very common, that you need perfect credit to buy a home. A lot of people assume this. But is that really the case? Today, we're going to break it all down for you, separating fact from fiction. But before we get to that, a little coffee talk with the Joes. This week, Joe, is my favorite week of the year. Do you know why?
I can take a gander on it, but since I already know, I'm going to let you tell everybody.
Because this is Augusta week.
It is
Masters, one of the four majors of the year, on probably the most prettiest course out there, the magnolias and it's just amazing. It is definitely on my bucket list to go to the Masters for the tournament one time.
When do you start watching it? Have you already been watching the live and all that stuff on the golf channel? Okay.
Yes.
Okay.
Yes.
So what is taking place so far? I mean, we had Monday and Tuesday. So
they do a kind of like a par 3 challenge, and they play. They have the families of the pro right play with them. You see that? Love seeing
and
that.
They're in the white overalls, aren't they?
Yeah,
the kids and stuff. Yeah, I seen that. Have they already done the skipping the water or skipping the ball over the water, or is that?
Yep, they did that as well. Yep, I can't remember which hole that is that they do that on. It's 16, I think, or something. I can't remember.
Yeah, I can't remember which one, but I watch a lot of that. I will tell you the truth. When it comes to Masters Week, I turn it on Thursday, and I have it on Thursday through Sunday. I don't do all the stuff before, but that's the stuff that, I go back and I see the highlights on.
Yeah.
I think that's more fun watching the kids. What is it? Finau last year had, I don't know how many kids he has, but I think there was multiple kids that he had running around in the white overalls last year. And that was fun to watch.
It is super cute to see their kids out there in those overalls, rolled up, of course, because they're too big, the arms and the legs are all rolled up and everything. Super cool to see.
Very true.
I even have the app on my phone.
So you're into it the whole time.
Yeah, I'm there. It is. I mean, granted, it would be amazing to play that course. I've played some amazing courses before, Pebble Beach and Pinehurst and stuff.
Yeah.
But man, Augusta would be wow. That would be something.
That is a select few that get on that course and play. If you're not a professional or a member, right?
Yeah.
So
you have to be a member to play on that one.
Yeah, and that's not something that I can afford.
No, definitely not. Definitely not.
But, again, playing there too, you might have to have perfect credit to get on that golf course, to tell you the truth.
Well, while not everyone, has the perfect golf swing, like the pros at Augusta this week, we still show up, you and I, of course, Joe, and play at our favorite local course, which really brings us to today's myth. We're tackling the idea that you have to have perfect credit to buy a home, and just like in golf, perfection is not required to play the game.
Right. I like this myth, to tell you the truth. I know we're going to get into it. I want to give a shout out first to Mr. Brownstead. Thank you very much for the coffee cup. I don't know if it's coming through. I don't know which one. There we go. BRE, Brownstead Real Estate. Thank you very much for the coffee cup. I appreciate it. If you're looking for a good real estate agent in the Dallas-Fort Worth area, I know Mike Brownstead, by what he goes by, is a great one. So, giving him a shout out because he came into the CE class last week and he brought me a coffee cup. I really appreciated it. So, today, viewers, this is another one where we want some interaction. We want some questions. We are going to get out of here on time for once because I have a training that I'm doing after this. But please drop your comments in. Please make comments, ask questions. I already see Mike already said, thanks
Mike.
for the recommendation. We really appreciate you. You've been watching nonstop, so appreciate that. But we want questions when it comes to the credit from anybody watching. So, let's kind of jump into it. Joe, what do you see when you're doing credit from a lender's perspective? What are they looking for? Because we just said it's a myth, right?
Mhm.
Perfect credit to buy a house, you don't have to have it. But
Yeah.
what are some of the things that lenders look for on credit that clients don't know or don't understand?
So everybody thinks that, we pull your credit score or your credit report because we are looking at your credit score. Yeah, that's the first thing that pops up. Okay, we see the score, but we dive the main things that we're looking for is beyond the credit score. We're looking at what we call your trade lines, right? Lines of credit that you have. We're not talking about your cell phone bill or your electric bill and stuff. I'm talking about credit cards, student
Yep.
loans, car loans, and whether it's a loan or a lease is going to make a difference, right? And just I'm sidetracking a little bit, but the difference there because I have one client that we're actually able to omit his car payment because he's only got 7 payments left on his car note, right?
Yep.
And it's not a lease; it's an actual loan. So under 10, right, Joe? 10
Under 10 months.
10 months
There's some
of
other
payment.
criteria to it from a guideline standpoint, but under 10 months of payments on an installment debt.
We can omit that, right?
Yes. Yeah.
So, we're looking at the different trade lines. That's a big one right there, right?
Yeah, I think, for people that are buying a house, the reason we're looking for that is you're wanting to see current payment history, which your FICO score is affected by late payments. It's also affected by high credit card balances, like if you're maxing out your credit cards. So we're looking more at what activities you're doing. One, to see, okay, what does your cash flow look like for your debt to income ratio when you're buying a house? Are we able to help you budget? And one thing that a good loan originator does and a professional, they're acting as kind of like a financial advisor to make sure you're budgeting right. If you get a loan originator in there and a real estate agent that only wants to know can you max out at? What can you max out at?
Mm-hmm.
That's not the person that's in your corner that's really trying to make sure you're getting into a house that fits your budget.
Mm-hmm.
Because I can max out anybody, but does it make sense to have, 60% of your income take home, because we base it off of gross, but 60% of your take home go towards a mortgage payment?
Mm-hmm.
I'm not doing you a service.
No.
So, that's one thing that Joe's kind of talking about. But the things that lenders are looking for, why do they look at credit scores? Why do we have credit scores? If it's a myth, you don't have to have perfect credit. That's the question that I think some people don't understand. The FICO score helps us with pricing. What pricing is the higher your credit score, there's what's called loan level price adjusters in there for different investors, depending on if you're a first-time home buyer or not. That FICO score helps you have less adjustments to your pricing for the interest rate. So that's one of the big reasons why people want a higher credit score.
Mm-hmm.
Joe, if I'm looking at Credit Karma, I'm going off script a little bit, but it's part of what we're talking about today. If I'm looking on Credit Karma and you pull my credit, why is it different?
Well, there's different scoring models, right, for different types of credit that you're applying for. So there's going to be a different score model used for credit cards, right, and compared to a mortgage, right? Now, so a mortgage is using different FICO models, and actually each for a mortgage, Experian, Equifax, and TransUnion each one of them use a different FICO scoring model. Experian uses the FICO 2, Equifax uses FICO 5, and TransUnion uses FICO 4. So that's also why when we pull a credit, at least when we do a hard credit pull, and we'll talk about hard and soft credit pulls in a minute, but a hard credit pull, it pulls in all 3 credit bureaus. And with that, we get 3 different credit scores. Why? Because each one of the credit bureaus are using a different FICO scoring model. Now, if you look at something like, like Credit Karma, you were talking about, right? Credit Karma. So Credit Karma uses Vantage 3.1 credit scoring model. Okay. So that's why if you use Credit Karma, and Joe, you and I were talking about this off air, I'm sure we'll get into, but if you're using Credit Karma, you're looking at more of a consumer type scoring.
Yep.
So when we pull your credit, it's going to be different because it's a different scoring model that's being used, right? So, we'll get people that'll tell us, well, why is it on Credit Karma it's showing I have a 672 credit score and you're telling me I've got a 641? Why is there a 30-point difference, right? That's why, because it's a different scoring model.
Well, I like how you said it. When you're looking at it on your credit card, online, or your bank, if they offer a FICO score, those are more consumer directed FICO score calculations. That's why when either a car loan, sometimes they match up when it comes to a car loan because they're trying to be very liberal in the way that they're getting your scoring for the type of financing they do, because it's more of a short term finance. It might be 4 years or 5 years. I know they have 7 and 8s too, but you have the higher interest rates for them. But it's a shorter term loan. Mm-hmm. So they're willing to take a little bit more risk than what a mortgage company, when this is a 30-year commitment or a much larger dollar amount. Now, I know there are some cars out there that are hundreds of thousands of dollars, but you're going to have perfect credit for those kind of cars. But when it comes to a mortgage, they're looking at a longer term. So that FICO score changes in the calculations. So it pulls in more information, and it bases it off of more of how your spending goes on your credit, from credit card balances going up, balances going down. It's looking at that, and it's being a lot more conservative on that FICO score calculation. So, bottom line is you don't have to have a perfect credit score. It does help you when it comes to pricing, but it does not actually make it to where you get a loan or don't get a loan if your score is a little lower.
Well, like you said, you don't need perfect credit, right, to be able to get a loan. So let's explain that to our audience, both of them that are listening. When let's look at, Joe, just the standard mortgages, FHA, VA, conventional. What type of credit scores then do people need to be able to qualify for those?
So, I mean, you brought up all the different types. So let me break it down a little bit. So if you're, the way that I look at people's credit, if you're at a 720 and above and you're putting down 5% or 3%, I'm probably looking at conventional first because of the mortgage insurance, because it's based off of a credit qualifying for a better mortgage insurance payment. So I'd probably be looking at that. If you're below a 720 and you're still only putting 3.5%, 5% down, I'm probably going the route of an FHA. And the reason for it is because, they're backed. So the pricing and the rates are a little bit better for the lower credit scores. Your mortgage insurance is a lot better if you're a 680 FICO. So I'm going to look at an FHA. If you're under 680, I'm looking at FHA, USDA, depending on the area. And I'm not even looking at conventional unless you're putting 20% or more down, because at that point you're getting into private mortgage insurance on a conventional deal that, you could be looking at $200, $300, $400 a month in a mortgage insurance payment, depending on the size of the loan. I'm probably talking about a $450,000 loan or higher with that type of mortgage insurance. Yeah. Where on FHA, you might have a $150 or $200 mortgage insurance payment. So, I'm gonna base it off of that. So, you're a little bit more credit challenging, where your credit score is in the mid sixes. I'm probably looking at an FHA or a government product first. That makes sense, because we can always refinance off and get on conventional and drop that mortgage insurance.
Yep.
Right, depending on the market. So, that's what the easiest way I could break it down.
Yeah.
In my opinion. What about you?
So then let me ask, what's so that everyone knows, because you're talking about scores in the mid 600s and 700s. So what's the minimum score for an FHA loan?
Honestly, all the way
Especially
down
for
to
our first time home buyers.
well, all the way down to 500, depending on manual underwriting, things like that. So that's another myth that I wanted to make sure we talk about. Now, under 500, we're in a whole different ball game. A lot of times, you're not going to be able to get that done on a standard loan.
Yeah.
There are other products out there, but for a true FHA, you want a 580 and higher credit score to really be in the approvable range. So 580. And above on that. VA, there is not a credit score requirement. So that's another one that, I would look at, especially for our veterans or an active military.
That's definitely a myth out there, right?
Yeah. Yes, there is a myth. And there's actually not a debt to income ratio. Now, some investors have a max, but on VA, there's not a max debt to income ratio. It just depends on your situation, your cash flow. So, again, don't let your credit stop you from talking or looking into becoming a homeowner, because that's the big parts about it.
And conventional, you talked to FHA and VA. What about conventional for people?
Conventional 620 is the minimum that you can have to qualify on conventional. Now, there are another little thing about it is Fannie Mae changed the way that they do it. They will do an average for your AUS approval. What that is our automated underwriting system, to where, let's say you have a 660 on one and your mid's like a 619 and then your low is like a 618. Well, if that average gets you above, you could still get approved with a Fannie Mae loan if you're putting down enough money and you're not having to worry about the mortgage insurance. So that is another myth, that you can't be below a 620 and get a conventional. We've done them. It's not a typical type loan, but they have changed that up when it comes to getting approved. So if you have a co-borrower, let's say you're the primary and your co-borrower is scores lower, that could average it up to where you could still get approved with conventional. So there's different ways to look at it. It's not a hard stop anymore on that 620.
So let me ask you this question then in lieu of that, because I've recently had a lot of first-time home buyers, especially with some of the first-time home buyer seminars I've been doing, come to me and they don't think they're ready yet, right? Their credit isn't where they think it should be or where they want it to be. And so they want to wait, 6 months or a year to get that credit higher so they get a better interest rate. But what is your thought on, let's say somebody has a credit score, just as an example, in the low 600s.
Okay.
Do you think it's worth waiting 6 months or 12 months to try to boost it up?
So this kind of goes into play with waiting until interest rates drop. I look at these as the same. And the reason I say this is, if your credit can get you qualified now to buy a house and the payments are something that you can budget, maybe they're on the higher end, but you can budget that payment right now based on where your credit is today. Waiting 6 months, waiting a year, that house is now appreciated. And now that house that you were buying today, maybe at $300,000, you're now paying $325,000 for it in 6 months, $325,000, $350,000 in a year. So now what you're paying more for the house that you could have bought $25,000 or $50,000 cheaper, just because your credit wasn't there yet, or just because the interest rate isn't low enough yet. Well, the great thing about that is now let's say you bought that house 8 months later, 9 months later, your credit score is now a 760. Your house appreciated. You only owe 300 on it. Right. But now it's worth 325 or 350. We can do a refinance, possibly get rid of mortgage insurance, possibly lower your interest rate, drop your payment, but you still have that equity, which you wouldn't have had if you waited.
Right.
So that's my take on it. And
the mortgage payment itself is going to help you in building your credit up.
Right. Well, you bring up another good point. Are you renting? Is that $2,000 a month rent payment. So now you take that times 12. Now that's 24 grand. You just paid somebody else where you could have paid 24 grand towards your own equity.
Yes.
So, not all of that goes towards equity, but your interest in your equity, right? So, Joe, I'm going to get into a true false game with you right now because you started this and I kind of like it. So I'm going to ask you some questions and see. So, think we kind of talked about this and hopefully some of our listeners can do it. Thank you, Hillary. Hillary Castillo. She's an awesome real estate agent up in the Denton area. We've done a couple of loans together. Really appreciate you watching today. Wanted to give her a shout out also. But Joe, here's your first question.
Oh, okay.
Do you need a 750 plus credit score to get a mortgage?
No, you don't. That's false. That is a huge myth. I think we've already kind of discussed it a little bit. So thankfully we've done the true and false questions after talking about it. So I have the right answers.
All right. They get a little harder. They get a little harder.
Oh, okay. All right.
So the next one, does bad credit mean you won't qualify?
No, that is false again.
Okay.
False. That is a myth.
Can you expand on that a little bit? Let's say that they are under that 580 credit score and that they are under that 620 credit score and they don't meet the requirements for conventional or Fannie or FHA. So kind of expand on that just a minute.
Okay. So matter of fact, Joe, you and I together as a team, we just helped someone last month, a veteran, right, that had a credit score below 580. And we were able to get that loan closed, and they're enjoying their new home now, which was just so heartwarming, I think, for both of us to be able to get that accomplished for them, especially as a veteran. But I was below 580.
Yep.
Right? So is it possible? Yes, it is. Now, is it messy below 580? Yes, it is. Okay, it is. But we're still able to get you in that home and stop paying your landlord's mortgage, right?
Yeah.
We were still able to get them to, fire their landlord.
You're going to answer a lot more questions when it comes to you having lower credit and stuff like that. So your loan originator, the underwriters are going to ask questions, and don't get frustrated about it because sometimes they come up until the last week of the process. The day before, there are times because there's so many more moving parts in those type of loans. So just know that if you're having to go that route, great, you can get you into a house, but you might have to answer more things. It's going to not be as smooth of a process as others, but it can still get done, and proper communication can help you with that. So thank you for answering that one. Joe, I've got one last one for you.
Okay.
I want to check my credit multiple times. So if I check it with a lender, will it hurt my credit score?
Well, now I have a question back on that, though. How are we checking the credit score? Is it a soft credit pull or a hard credit pull?
Well, there you go. I like how you asked that because some people always say, "Oh, it'll hurt my score." So, Joe, explain. Does it hurt my score if I do soft pulls?
Okay, so let's talk about both of them, actually, right?
Okay.
So a soft credit pull, which I know, Joe, you and I do always right up front. We do a soft credit pull because number one, we don't want to ding your credit, until we have to. We just want to be able to take a peek at your score and the liabilities, see what the monthly payments are, and that so we can calculate out your debt to income ratio. And if everything looks good and fits, right, then we can go ahead and move forward and do a hard credit pull. But before doing that, and this is the second reason why we do a soft credit pull, is that, the credit bureau, if we do a hard credit pull, you're going to have like 40, 50, 60 phone calls a day.
And that's not us selling your information.
No, it's the credit bureaus that are selling your information. This is part of how they make their money, selling your information, your contact information to all these online lenders. And they are ruthless. They're relentless in calling you, right? So that's the other reason, the second reason why we do a soft credit pull. Now, let's talk about, which, by the way, we help you. Joe and I can help you in getting around that, by the way. Okay. So reach out to us. We can drop it in, maybe a link or something in there, but we can definitely help you get around that as we do with all of our clients. Now, hard credit pulls. Let's talk about hard credit pulls. if you have a mortgage, let's say Joe or I do a hard credit pull on your credit, yes, it's going to ding your credit, but only like 5, 6, 7 points. That's it. It's not that it's going to ding it by like 20 points. Okay. So it's minimal. But once you have a mortgage lender pull your credit report, you then have 30 days to shop around and have, I don't care, 6, 8, 10 other mortgage lenders pull your credit, and it doesn't affect your score. Only the first time that mortgage lender pulls your credit.
I still will tell you guys, when you do this, okay, we are telling you it won't affect your credit from a standpoint of how the FICO scores are done. But if we pull your credit, 2 weeks later, another mortgage company pulls your credit, your score could be different. And it's not because of the hit. It's because maybe your credit card balance reported differently. Yes. And when we pulled your credit card balance was higher, so your score's lower. And then when they pulled your credit, it reported because you made a large payment to that credit card, and it reported, and now that credit score's up. So just understand, or it's down, right? It could be either way. Just understand there are still factors in that 30 days that your score could go up and down, but it's not because of the inquiry, is what Joe's getting at. I just want to make sure we clarify that, because that's another myth that people think, hey, if I get my credit pulled, it's going to hurt my credit score. It will do something to it, but just because we pull your credit and 2 weeks later another one pulls it and that score is higher or lower, it's not because of that inquiry. It's because something else changed on your report. Yes. Just wanted to make sure you guys understand that a little bit too. Joe, I know we're getting down to the time. Let's talk real quick about
some tips.
What?
How about some tips for our?
That's what I was going to say.
Kind of some pro tips, if you will.
So
that we see as professionals.
One of the ones that I want to make sure is don't close old accounts. So if you have credit cards that you started in the 90s, those ones are awesome on your credit. Keep using like $10, $20, go to dinner, pay it off, whatever. Keep using it so your creditor doesn't close it, because that is actually driving your score up because of the age of that account. So the older your accounts are, keep those open, but keep the balances low, and that'll help drive your score up. That is one pro tip that I would tell you guys.
Definitely.
Joe, what do you got one?
Yeah, and I'm going to use an example of a client that reached out to me a couple of weeks ago from her realtor. She's actually not looking to purchase a home until her lease is up in September, right? So we're talking almost 6 months. And I congratulated her because she's being very proactive, because we actually have some things to do on her credit in regards to student loans and a car note that she co-signed for her son. So taking action now helps us be able to put a plan together, so that when the time comes of actually, putting offers in and getting that pre-approval letter so she can put offers in, doing it now ahead of time is perfect. Doing that pre-planning, if you will. So I think that's very, very important.
Yeah.
On that. Yeah. So let's kind of, I know we're towards the end here, Joe, and I know you got to get going. So just to kind of bottom line everything, understand perfect credit is not required to buy a home. What is required, though, I would say, is a game plan. Yep. And both Joe and I are here to help with that. So if you've got questions or concerns, about your credit, your situation, perhaps, in regards to applying for a mortgage or preparing to later this year, reach out to Joe and I. There's our email down there at the bottom, or email address. We'd be glad to set up some time just to, discuss your situation and what your goals are, honestly. Next week, we're going to continue on in our series of busting mortgage myths, because, well, there's just so many of them out there. So tune in next week at our usual time, Wednesday, 9 a.m. Central, as we cut through all the noise and bust the myth commonly heard out there. And this is a big one. It's cheaper to rent than buy. I'm going to like that one. That's going to be a fun one. I want to thank everyone for listening in today on today's show. if you know of anyone who might be able to glean from this, as far as what we've covered today, or if you want to catch up on any of our past episodes, go to our YouTube channel at the Mojo Show Real Estate Podcast. Also, I will tell you, just a little plug here is that if you go to our YouTube channel, you'll see an episode there. It's episode 16 that we had Brian Quinn. Shout out, Brian, to you. We had Brian Quinn on the show. He is a credit analyst, and he came on the show and really broke down credit for all of our listeners. So go back, listen to that one. It's a great podcast to listen to. And while you're there, be sure and hit the subscribe button, because, well, we are on a mission to get to 1,000 subscribers, and every like, comment, and share helps us, reach more home buyers just like you. So before we close things out, any last words or nuggets of advice for our listeners, Joe?
Hey, if you have questions, reach out to us, because we're here to help, and just make sure that you're doing the right things for your credit, and we will get you into a house.
Absolutely. I'm Joe Mortgage, and that handsome guy with the beard is Cup of Joe Mortgage, and we'll see you next week.
Mr.